As an investor, it is not just enough to invest in stock markets. Having your goals linked to your investment is a key to realizing the full potential of your investments. Now, how should you do that? Should you be choosing SIPs or lump sum route to achieve your investment goals? Now, to help you invest smartly, we have with us Misbah Baxamusa, CEO, NJ Wealth. Misbah, welcome to the show. The first question to you is, let's help viewers in explaining why is it important to have a goal lined up for your investment, because a lot of investors keep their financial goal as being, wealth creation is always there on their mind, but no clarity as to what's the purpose of their investment portfolio, what's the time horizon for a particular investment that they have, what is the risk appetite. Don't you think this is the basic thought process that one needs to put down and then start your investment process?
Kavita, if I have to answer this, and I also been interacting with a lot of investors, to me, they ask what is the definition of success in investment, and if I have to answer the definition of success in investment is concerned, I think so the success is measured in a way as to how your goals are getting achieved from your investment. So to me, the goal is the fundamental to any investment. And if an investment is done without any goal in your mind, generally an investor tends to make a lot of mistakes. So SIP getting stopped in between, or money getting redeemed in between, what exactly I need to do, all those questions are not answered. People are just investing for the sake of doing it because we have been ingrained with that habit of saving and investing, and that's what most of the investors do. And the end result really is not what they really want, right? So to become a successful investor, the fundamental which I talk to all my investors is that the fundamental is that a goal has to be defined, and the investment has to be done sufficing that particular goal. So that is something which is extremely, extremely important, or else you as an investor are tend and bound to make mistakes, whether by investing less or whether by withdrawing or stopping your investor in between to probably do certain expenses or something which you probably are, it's not your actual need.
Right, but then a lot of investors are confused whether they should be going through an SIP route or lump sum route. Especially a lot of Indians believe that, when they have a chunk of money, they would start their investment process, or they usually prefer investing when they have a lump sum amount to put in somewhere. How can one really go around with this lump sum investment strategy? Do you think putting money in chunks is a good strategy?
No, so I'll just, add few points which I had covered in my previous talk. First I said that goal setting is extremely important. Now your question is that whether I just invest when I have money, so my point is that the first important is to understand that this is the goal which I need to fulfill. The second thing which comes into is you ascertain a value of that goal, because that's another place where people make lots and lots of mistakes, right? The basic example is retirement. In retirement, generally what people or what is the basic input value which is needed is what is the current expense. And most of the people fail to derive that current expense in the planning, and that's where most of the planning fails in. So as I said before, goal setting is extremely important. The second most important thing is that during the process of the goal setting, what values you are putting to that goals and how you are inflating it for the future is the second most important thing. Once you are done with that, automatically you will have lots of clarity as to what is the kind of investment I would need to either save, whether it is in a lump sum manner or in an SIP manner. And that's the right way actually to go about investing. So investing is not about कि आपके पास you get the money, you have something to invest into, and you invest, because as I said before, if you have that habit of doing the investment in a way that today I have some disposal, I invest without anything in my mind, I repeat again, you are bound to make mistakes.
What's the difference between investing via SIP or lump sum? Because a lot of people are comfortable through SIP. Okay. Also, because what they do is they spread out their SIP investments over a period of month. But then lump sum investment happens as and when. So, how can one decide what kind of an investment route is good for them?
Yeah. So, I think so. There has always been a debate as to whether I should do lump sum or whether to do SIP. I think so. The first important thing that is for an investor is that they need to invest with the goal in the mind. So that is the second most important thing. As far as route is concerned, whether I should do a lump sum or whether I should do an SIP, one thing investor should know that it is a function of your cash flows. So if you have an erratic cash flow as earnings, you don't have an option of investing in an SIP because your cash flows are itself erratic. So and hence, any distributor would tell that whenever you get your money, you have your goal in your mind, you know how much to save and where to save to achieve those particular goals. So whenever you have lump sum, put that money to for the perspective of achieving the goal. If you are lucky enough and you have a very determined cash flows which are known to you, which is hitting your bank account on a regular basis, you have a goal in your mind, you have an amount which has been told by a distributor that this is an amount you need to save on a regular basis to achieve the goal. And if you have a regular cash flows, you probably end up doing an SIP, which is a very good habit because it takes away the money what you receive in your bank on a regular basis. So the lump sum and SIP are nothing but a way of investing, and they are pretty much a function of what kind of a cash flow an investor have, right? So an investor has to resort to a lump sum investment if the cash flows are erratic. But again, I would say that if the cash flows to your bank account are quite regular, SIP is one of the best route to invest into.
Misbah, you must be interacting with a lot of investors, and I'm sure you must have come across investors who are confused about doing an SIP or a lump sum. But for example, say an investor prefers a lump sum route. Now we know this pattern of investment is very erratic, the corpus is defined, what they want to collect, but the investment amount is not defined, the frequency is not decided. So how can one deal with this?
Yeah, it's a very good question, Kavita. See, generally, if the goal is identified and the tenor is identified, generally an output which we as distributor give to our investor is that you need to invest either this much amount of lump sum or this much amount of an SIP, which is either monthly or either it can be yearly, depending again with the investor comfort. Most of the time it is monthly. So you have a component which is either you invest lump sum or you invest on a monthly basis in order to achieve the goals. Right? So that's what a general output with any distributor and advisor would give to an investor. Now, say for an instance, the investor don't have probably a regular income coming to his account, and hence he says, no, I can't really do about doing an SIP. But yes, I can give you lump sum. Again, those periods are not defined. As and when I get, I'm in a position to give it to you. Generally, most, as I can say about us, and I think many others would be giving, they would probably give you a plan where there is a goal, there is a lump sum which is coming in, and they will, at an ongoing basis, point it out to the investor at a regular basis that this is still a gap which we need to fulfill. So if an investor is told about that, okay, this is still the gap which you need to fill in, so please tell us whenever you have money, because an investor probably what needs it is regular stimulus. So if an investor is told at every point of time that these are your goals, this is the gap which you need to fulfill in, and this is the kind of investment you already have, and still you need to give more to fulfill that gap or that particular goal. Automatically, the investor would, whenever there is a possibility, he will try to manage that particular fund and put it for that particular goal. So it's all about, the proper presentation which it is done to the investor. And if that proper presentation or proper awareness is getting cultivated, automatically investor, is very, very clear, Kabhi, I need to save this much whenever I can, of course, because he don't have a liberty because that's an assumption that you have asked me that I don't have a liberty to do on a regular basis. But then I think so it's about reviewing the goals at every point of time that would ensure that an investor gives that money whenever the money is available. But so that's what I can really tell.
So, Ms. When an individual does an SIP, it's discipline spread across the month, so they get to participate in all market movements and levels. Now, that really mitigates the risk. But then what about lump sum investments? Do we have to keep a check on market levels and movements to do that?
See, my answer is very simple. In investment, we all say, or we all tell to our investors, and that in investment, what is important is time that you give to your investment and not timing. Because according to us, I don't think so anybody are made up to really know exactly today is a good time to invest or today is a good time to exit out of the market. I don't think so. None of us have an answer that today is probably a time to sit on cash and probably would wait to invest. So I don't think so. A lump sum investor have that prerogative to probably decide as to I will sit for some time and I will invest when the market is right, right? But what I understand is that in investment, especially when it comes to equity investment, if you give sufficient time to your investment and your goals are quite prolonged, so your goals are say, and that's what it is important to, identify goal at an early stage rather than identifying the goals at a very later stage. If some person, identify a retirement goal at 55, I think so it becomes a little difficult for him, because that time availability is less. But in general, if you have identified your goals at the right time and if you have given sufficient time to your investment, I don't think so the date on which you invest really matters. So if you go back 20 years before and you chuck out every day as to this is the day I have invested and what is the return after 20 years, the difference between the minimum return and the maximum return is going to be very minuscule, right? So if you give time to your investment, I don't think so that day that you decide to invest is going to make any difference. I think that what is more important is that you invest for that particular goal. Because many a times what happens is that in the whole framework of timing, that this is not the right time to invest, people forget to invest and hence many of the goals don't really fructify. And that's how I think so is something which is called, and as I said before, a definition of successful investing is all about fulfilling your goals.
All right. Thank you so much, Misbah, for removing time and explaining our viewers as to what's the right route of investment for their portfolio. Thank you so much.